Hi, I'm Jenny Browne, Business Development Director at Mortgages for Business. Thank you so much for joining us here today at the National Landlord Investment Show. We're delighted that you've taken the time to come and have a listen to what we've got to say. So look, my name's Jenny Browne. Like I said, I'm the Business Development Director at Mortgages for Business. And when we were really thinking about what to talk to you all about this time around, we had a good long think and actually figured that limited company buy-to-lets really are the thing that most people seem to be, in our experience anyway, interested in at the moment. Since the introduction of Section 24, from our perspective, there has been a notable shift in terms of investors favouring limited companies as their chosen vehicle for acquisition. And this has really been building in momentum ever since Section 24 was announced, culminating, interestingly, last year in the highest number of limited companies which were registered at Companies House with the purpose of investing in just property. Ever on record. So it really is the way the market's going. Now, what I would just say actually here is that if you are an investor who still wants to invest in personal names, or you're not quite sure which way to go, that's absolutely fine. It doesn't mean that your only options are through limited companies. And at Mortgages for Business, we are able to offer mortgages for people both in personal names or through limited companies. But actually, if you are in a position where you are thinking of investing and you aren't quite sure which way to go, I would just caveat this right now that the thing you really need to do first of all is get some tax advice. We're very good at Mortgages for Business, but tax advice is not within our remit, so you need to speak to a qualified tax advisor. But yeah, so really we just got the absolute idea that, you know, limited company lending really is a very popular topic at the moment. We look at trends on Google and all that kind of stuff, and we can really see this is what people are interested in. So we hope this is going to be of interest to you all today. Now, in terms of what you can expect from the next half an hour or so, what I'm going to do is just give you a quick introduction to Mortgages for Business and also myself. I think it's always nice to know who's talking to you. We're then going to go into the full presentation, and we're going to first of all kick things off by talking about the basics of limited company buy-to-let mortgages. We're then going to talk a bit more about why people would actually use limited companies, and it's a bit more involved than maybe you might be forgiven for thinking. So we're just going to run through some of the scenarios that we've seen firsthand of people looking to utilise limited company structures. We're going to also talk about the parameters of limited company borrowing, so the kind of things you can expect when you're looking for a buy-to-let mortgage, and also just let you know some things that you may want to be aware of. In terms of not necessarily risks, but things that's just slightly different when you're applying through limited companies than when you're looking to do it personally. We're going to cover off layered structures as well, because this is something we're seeing more and more. So just go into those and just talk a bit more about what they are, why people use them, and also, you know, what is and isn't acceptable in terms of mortgage lenders. And then we're just going to go through some of the frequently asked questions that we see our clients asking us about. So that's really kind of the shape of the next half an hour or so. So a fairly packed agenda. But like I say, before we kick things off, I just want to explain a little bit more about Mortgages for Business, who we are, and actually who I am as well. So Mortgages for Business is a whole of market mortgage brokerage. We have two offices, one in the southeast in a place called Kings Hill, which is kind of in between, I guess, Sevenoaks and Maidstone. And we have a second office in Wilmslow in Cheshire. Now, we are not limited by location. Our clients are based all over the country, indeed all over the world. We don't have to meet our clients face to face. We're able to help you wherever you are based. Now, as a brokerage, we've been trading since the 90s. At the moment, we have a headcount of around just under 60 staff. We do definitely specialise in buy-to-let mortgages. That's really the mainstay of our business. But in addition to that, we do all types of first charge lending. So homeowner mortgages, residential mortgages, commercial investment, commercial owner occupier, development finance, bridging finance. So everything you would really expect a mortgage broker to be able to do. Now, Mortgages for Business, we're quite keen that when you do phone us, you speak to someone who's a real expert in their field. You simply cannot be an expert in all those different types of mortgages that I've just outlined to you. So what we do is we break our people down into certain teams and specialisms. So if you phone up looking for development finance, you're going to speak to someone who's a development finance expert rather than someone who does loads of buy-to-let mortgages and the odd development case, and therefore probably wouldn't be quite as experienced and able to help you in the best way possible. Now, in terms of myself, I've been at Mortgages for Business for, I think I'm on my 15th year now. It gets to the point when you just lose count, but it's been a really long time. I've been advising clients and broking mortgages since I've been there, and so I've obviously broke thousands of mortgages in my time. I've been through a credit crisis and now a pandemic as well, one I didn't expect to have on the CV at any point in my career. It's been an interesting year for us, as it has been for everybody else, but we're incredibly grateful. The market has been able to continue trading, particularly after the first lockdown. And actually things are really moving on now. So look, loads of experience in my part as a mortgage brokerage. I'm also a landlord myself. I have a buy-to-let through a limited company. I also have another property which I own personally. So I've been through the mortgage experience, both as a broker but also as a borrower. So I understand what it's like. I know the kinds of questions and concerns that people will have. So that's me, that's Mortgages for Business. I hope that's interesting and helpful and you feel that you're in safe hands for the next half an hour or so. So I think it's now time to move on to the presentation. So first of all, the big question we get asked, very, very often is what actually is an SPV? So an SPV is quite simply a limited company which has been set up with the sole purpose of renting out property, and it really is no more complicated than that. You don't need to do anything fancy with the company or anything like that. The only thing, or in terms of how a lender would know that the company is an SPV, there are really two things that would tell them. So first of all, when you set a limited company up, at some point you need to let Companies House know what your company does. And on the basis of what you say the company does, the Companies House will allocate what's called a SIC code, a Standard Industry Classification Code. So it could be that my company is a dentist, it has a code for being a dentist. My company is a shop, has a code for that. In our case, a company would be for letting property, so your SIC code would be appropriate to that. So when lenders look at the company details on Companies House, they can see that the company has a SIC code which tells them that the company rents out property. Now, the other way a lender would know in the future if a company is really an SPV is by looking at the limited company accounts. So when you look at a set of accounts, it becomes quite apparent if you have income that's just coming in from rental property and expenses that are going out on the same basis, or whether there is other income sources coming in. So that really is as complicated as it is. So to set up your limited company, you would go onto the Companies House website. You don't need to pay a company, an external company, to do this for you. It's expensive. You can set the company up online yourself. I think it costs about 20 quid. When I did mine, it was very, very straightforward. In terms of things you need to be aware of, so I found the most challenging part actually deciding what to call my company. And we see some really cool company names. The company name does not need to be specific to letting property, by the way. It can be whatever you like. So you would set up your limited company on Companies House. Things you need to be aware of, so you're going to need to be able to register or name the company directors and the shareholders. If you're going to have any kind of complicated structures, you may want to get a tax advisor just to tell you how to set this up, what's going to be a good way of doing things. In my case, my company, I'm the sole director, I'm the sole shareholder, so it was very, very straightforward. And I think realistically, in our experience, people where it's, husband and wife or investor and business partner and their spouses. These are the kinds of company structures which are very, very easy to set up online. But if you're looking for something a bit more involved where you've got children, maybe taking on smaller shareholdings and stuff like this, voting rights on shares, you may want to get someone just to advise you on the best way of doing it. So like I say, the SIC codes are the codes which tell Companies House what your company actually does. The codes that lenders really like to see for limited company borrowing are 68100 and 68209, just for your reference. And really these codes just tell Companies House what your business actually does. Now what I would say is that by having a code that says renting property out, if you did decide that you're going to then diversify and run an IT consultancy through the same company, not having that SIC code doesn't preclude you from doing that. It might cause you problems when you come to get a mortgage later, but the SIC code doesn't sort of drive what the business can and cannot do. It's really just to let Companies House know what it's up to, and it's also very handy for mortgage lenders. Now the other point here about can I apply for a mortgage through a newly set up limited company, this is something we get asked really, really often. It's a very good question because ultimately we're asking a lender to lend to an entity with no track record, no financial history, and the answer is yes. You can set up a company today and you can literally borrow through it tomorrow, and it is that quick to set them up as well. It registers overnight. So you can set up a company which is absolutely brand new. How are lenders able to do this? Because they take what is called unsupported personal guarantees from And this is where it gets a little bit more involved, but either the directors and the shareholders, or shareholders with a certain percentage, but ultimately they're actually hanging their hat on the people that sit behind the company rather than the company itself. So this is where you'll hear the terminology personal guarantees. So what that actually means is that if, for example, I own my property through my company, I don't pay my mortgage, my property gets repossessed and sold on, the proceeds of the sale mean there's not enough money to repay my mortgage, then I am personally liable for that debt. What the lender is not doing is taking any charge over my personally held assets or anything like this, but fundamentally I'm on the hook for making sure that the mortgage is always repaid. But that is how lenders are able to lend to brand new limited companies. Now, in terms of why people use limited companies in the first place, I think there's more than one reason actually. I mean, the obvious one is tax. So the way you are taxed on the rental income in a limited company can be more favourable than the way you're taxed as an individual, depending on your own financial circumstances. And this is where a tax advisor really comes to the fore in terms of people you need to speak to before embarking on this route. But certainly in terms of our experience, Section 24, which was a big change in the way people are taxed, really drove the market in terms of the popularity of limited company structures. So there's definitely a tax element there, there's no denying that point, but there are actually more reasons as well. So another reason people often use limited company structures is because of inheritance tax planning. So essentially people will put their children on as shareholders, and then they're able to pass on ownership in a more tax efficient way. Again, this is another tax situation, so you'd need to speak to an advisor. Now, moving away from tax, actually there's another reason why limited companies can be quite popular, and that is all about the rental calculation, i.e. how much you can borrow per pound of rental income when applying for a mortgage. So when you're looking at taking a buy-to-let mortgage, the lenders will say we'll lend up to a maximum of 75% loan to value, as an example, as long as the rent can support the mortgage payment. And the mortgage payment is a calculation that lenders use, which will be essentially stipulated as follows. The rent needs to cover the mortgage payment, assuming an interest rate of X, with an extra coverage of 100%. So putting this into more kind of numerical terms, borrowing through an individual, the standard calculation that lenders would use is that the rent needs to cover the mortgage payment, assuming an interest rate of 5.5% with coverage at 145%. If you're going through a limited company, it would be the rent needs to cover the mortgage payment, assuming an interest rate of 5.5%, but the coverage needs to be 125% of that. So the coverage is lower, therefore you can borrow more per pound of rental income. And the reason that lenders take this approach of being more generous with limited companies is because of the way that they are taxed. So essentially you'll pay less tax, therefore you've got more money left over to cover the mortgage payments. And that's how it really shakes out. Now, I wouldn't say that using a limited company or the decision to use a limited company would be driven by being able to borrow more money. There's far more to it than that. And again, this comes back to a whole point about speaking to tax advisors. But certainly, without a shadow of a doubt, one of the advantages to using a limited company would certainly be this additional benefit of being able to borrow more. Now, the other reason people use limited companies, I come across quite often, and this will tie in nicely to our layered structures later on, is where they've got money in a limited company that they use for their day job. So, for example, I don't know, an IT consultant has a limited company, they've got some money in there, they don't want to withdraw that money and to use as a buy-to-let deposit because they would pay tax on it. So they want to try and leave it in a company structure and invest the money as a deposit that way. So that's another reason why. But again, once more, it's a tax thing. So of the kind of 4 scenarios I've just outlined, 3 of them are about tax, which really, and I know I keep saying this, but really hones in on the importance of getting some tax advice before you really sort of make any real movements on the decision to use a limited company or not. Okay, so moving on to the more kind of fundamental basics of the parameters that sit around limited company buy-to-let mortgages. So I think it's worth just first of all mentioning that right now there are 30 buy-to-let lenders that are offering limited company mortgages, which is almost double the number of lenders since the start of 2018. Now, in terms of why we're seeing an increased number of lenders looking to lend to limited companies is purely down to market demand. So more people want to borrow money through limited companies. Therefore, there is a greater demand for it, so more lenders come into that space. Now, what happens when you get more lenders coming into a space is that it drives competition and brings down pricing. So when I bought my limited company buy-to-let property around 5 years ago, the rate that I took out was about 4.2%. I subsequently, 3 years later, remortgaged it and was able to get a rate of 3.5%. So really just to demonstrate to you that the pricing has come down significantly. And we'll come on to pricing in a bit more detail shortly. So look, in terms of maximum loan to value on limited company lending, you can push things right up to 85% loan to value, but the rates are very, very toppy at that level. The best pricing sits at 60% loan to value, and then for every 5% you increase your borrowing above 60% loan to value, the pricing just starts to increase. I would say at the moment the real sweet spot is 75% loan to value. There are choices at 80%, they're not fantastic, but there are definitely choices, but at 85 it does become really expensive. Now, what we did see is pre-COVID, the 80% loan to value market had got quite busy and the pricing was looking very good. Lots of lenders stepped away from 80% lending when we went into lockdown. The market hasn't fully recovered from that yet, so there is definitely room to improve there from the lenders. And I do think as time goes on, once we see how things shake out over the rest of this year with regards to employment and the housing market, once we haven't got a stamp duty holiday really driving things forward and maybe potentially, dare I say, artificially inflating prices, lenders may be more comfortable going back into that space. But at the moment, the lenders are really, really busy. They don't have a huge amount of impetus or real motivation, I guess, to really push themselves in terms of their boundaries with their lending criteria to drive new business because they're busy as it is, so they're not going to take what they would perceive as unnecessary risks. So 85% loan to value is your top, but really 75% is where we see most of our transactions happening, where the pricing, in my opinion at least, gets quite comfortable. Now, like I say, rental calculations, as we referred to earlier, in terms of limited company borrowing. So if you said to me, what is the rental calculation for a limited company mortgage? The very stock response would be 125%, assuming an interest rate of 5.5%. That's the kind of industry standard wording. But actually, there's much more to it than just this. So I'm going to change the numbers around slightly and explain this in a very different way. At the moment, if you took a 2-year fixed rate, you could borrow roughly 175 times the monthly rent. So to put it into numbers, if your rent was £1,000 a month on a 2-year fixed rate, that would support borrowing of roughly £175,000. Now, if you were to take a 5-year fixed rate, the amount you could borrow will go up. And by that, what I actually mean is that the calculation would become 240 times the monthly rent. So in this scenario, if we've got rent of £1,000 per month, then in theory that would support debt of £240,000, which is, significantly more than the 2-year fixed rate would. Now, in terms of why this is the case, essentially lenders are able to take the view that if you take a rate which is fixed for 5 years, you're not going to be subject to interest rate fluctuations during that time. Likewise, over 5 years, one would expect rental income to increase. Therefore, you have more kind of wiggle room within your model to be able to withstand any kind of changes in pricing. And therefore, lenders are more comfortable to give you a greater level of borrowing because you're largely shielded from various changes in the market. So yes, so 240 times monthly rent as a rough guide for you is where you can get to on limited company borrowing rental calculations. In terms of interest rates, so look, at the moment they start from 2.59%, and that's for a 75% loan to value product. For 2 years. On a 5-year fix, you're probably looking at around 3.18% on a 75% loan to value borrowing. How does that compare to individual rates? Yes, they're definitely higher. Depending on the peculiarities of your situation, the kind of gap in terms of pricing will vary. So if you're one of our more complex borrowers, so for example, you're a landlord with 30 properties in the background, but you're still buying personally, you will find the gap in pricing between personal and limited is actually very, very small, if anything. Whereas if you're someone who's buying your second buy-to-let property, you have a day job paying you £40,000 a year, the pricing gap is actually quite large. But I think what we normally say to people is on average expect to pay circa 1 to 1.5% more on the interest rate. And so really then the decision about whether limited companies are for you comes back to taking that kind of interest rate cost versus borrowing personally, putting it in front of a tax advisor and getting them to compare or factor in the interest costs versus the tax position, and really deciding if it's for you. Now, in terms of other parameters that sit around limited company lending, there isn't a huge amount of difference compared to the personal borrowing market. So we have lenders that will lend on new builds, flats over commercial, high rise, studios, situations where you've got properties with shorter leases, the whole kind of suite of possible scenarios, which is endless, can largely be catered for in the limited company space in the same way that it can in the personal space. You will find that lenders who operate in the limited company end of the market tend to be the more what we would class as specialist lenders, who invariably are much more landlord friendly. So these guys don't tend to mind if you've got large portfolios. They don't tend to have a minimum income requirement, and there are some exceptions to the rule here, but largely their kind of view would be, we don't mind how much you earn as long as you are earning something. They tend to be more pragmatic with slightly more complicated like property situations. So with regards to, as an example, freeholder, leaseholder exposure. So they're just a little bit more commercial in my experience. So yeah, the market for limited company lending in terms of getting the mortgages, actually, if you can get on board with the interest rate differential, it's actually very, very aligned to when you take a mortgage out in your personal name. Okay, so despite me having just said that limited company buy-to-let mortgages are practically identical to personal mortgages, there are a couple of things that it's probably worth just pointing out to you that you probably want to be aware of. So the first thing is, just to recap, when you apply for a limited company buy-to-let mortgage, you will be asked to provide a personal guarantee. And as we previously outlined, that doesn't mean that lenders are taking a charge over your own home or other assets, but they are essentially going to be asking you to sign to confirm that you are ultimately responsible for making sure the bank gets their money back. So the liability actually stops with you, not with the limited company. And it's really important that people are aware of that. Now, some lenders will actually ask you to get legal advice. So everyone who's offering the personal guarantee will need to get what's called independent legal advice, or ILA as it's affectionately known in the industry, just to confirm that you've read through the personal guarantee document, as it were, and you know what you're signing, and that can come at a cost. So not all lenders ask for the independent legal advice, but if the lender does ask for it, just know that a solicitor is going to charge you for doing this. Now, another thing that we've got mentioned here is debentures. Now, debentures don't come up as often as they used to. Lenders tend to have moved away from these, but a debenture is essentially where the lender is saying, when we lend to a limited company, we're going to take a legal charge over the actual property itself, but also we're going to take a charge over the limited company. And the reason historically lenders have done that is really to ensure that if there are some problems with regards to the running of the business, so for example, you're not paying your mortgage, or you're not paying your ground rent and service charges to the freehold company or managing company, the lender is able to step in, take control of the company and start receiving the rents themselves to ensure that everything's getting paid on time and everything's brought up to date. Like I said, we don't really see debentures come up very often. These tend to be taken only by the more commercial lenders these days, but really just to kind of outline what they are for you. In terms of having a debenture and whether it's a problem, I think it's fair to say that in our experience, if a landlord is buying one property through a limited company and that's as far as they're going to go, they don't tend to mind if there is a debenture because it doesn't make any odds. But where we've got the situation where a client brings a selection or a limited company to the table which has other properties in it, their view is very much, I don't want you taking a charge over the limited company, because that can, first of all, it means that ultimately you've got control of everything within that company, which includes all the other properties. And likewise, also you have to get consent from the existing lenders to confirm that they're happy. So there's some kind of background to this, which some people are quite uncomfortable with. The other thing is, if you're borrowing not through an SPV, but through a trading company, you probably wouldn't want a lender having the ability to take control of essentially what is your day job, your business. So then some people are quite averse to these. But like I say, they tend to be, the requirement for a debenture is generally quite rare. Now, the other thing that we mention here is dual representation, and this comes down to really the solicitors that can act on limited company cases. So what you'll find is if you're buying a property and using a mortgage lender through your personal name, the lenders tend to say, yes, you can use your chosen solicitor as long as they're on a panel, and this will be a list of firms who the lender is comfortable acting for both you and for them, which is called joint representation. And this list of solicitors will be, normally it's massive. In the limited company space, what you will find is that the choice of solicitors can become quite small, and it really does depend on the lender. So some lenders, for example, Paragon and Precise, their acceptable panel of solicitors is massive. Someone like, for example, Keystone Property Finance, their list of acceptable solicitors is actually very, very small. And the reason that they do this is because they want to ensure that the firm who is acting for them, who is registering their legal interest in or charge over the property and making sure that everything is set up properly from a legal perspective, is absolutely watertight. And so there's only certain firms that they're comfortable able to, do the job properly for them and make sure that their loan is absolutely, 100%, pucker basically. So if you have got a solicitor that you're very, very keen to use and they're not on one of the lenders' panels, what you will find is that you can still use your own solicitor. And the lender will be fine with this, but what they're then going to say is, well, okay, you can use your solicitor to represent you, but we still want our solicitor, one of our chosen companies, to represent us. And this is where you fall in the situation of what's called dual representation, i.e. there's two legal firms involved. Now, in my experience, if you end up in a situation, it's not always the greatest thing. So the reason for that is twofold. First of all, you will end up paying for both sets of legal costs, so you almost end up doubling your legal bill. The second thing is, and I don't want to be derogatory towards solicitors, but having an extra solicitor involved in the mix, so you have the vendor solicitor, your solicitor, and then we have the lender solicitor involved as well. It adds in another layer of solicitors into the mix, which can generally slow things down a bit. So ideally that won't happen. So when you're looking at taking a mortgage through a limited company, it's worth just asking the question, can I use my solicitor? If you have a restricted panel, who is on that panel? Which firm can I use? What are the costs associated with this? And that can be slightly different, like I say, to personal borrowing, where the list of acceptable solicitors is normally very, very large, to the extent that you probably wouldn't even necessarily be aware that there is a panel in the first place. Now, layered company structures are something which we're certainly seeing more and more of at the moment, and I think it's probably because of the changing view from tax advisors and accountants in terms of essentially how people move money from one company to another. So let me embellish on that a bit further. So a layered company structure would be a limited company, which would be our SPV, which is 100% owned, so that 100% shareholding is owned by another limited company, which is in turn owned 100% by people. So a normal sort of flat structure would be a limited company owned 100% by people. A layered company structure would be a limited company owned 100% by another limited company, which is owned by people. Now, in terms of why people would use layered companies, so we tend to come across these mainly where our borrower has a limited company already, but they don't want to use that limited company as their investment vehicle. They want to have a separate company for the purpose of their investments. So a good working example of this would be if we had I say IT contractor, we seem to come across a lot of these. So the first ones that spring to my mind, an IT contractor who has a company which does IT contracting. So this is not an SPV. Over time, the IT contractor has built up a bunch of money which they've left in the business because it's more efficient to leave it in there. They didn't need to draw it out to live, to use to live on. So they've left it in the business because that's a tax efficient thing for them to do. So they then want to use this build up of funds to use it as a deposit for a buy-to-let property. And so they don't want to use their day job company, their IT consultancy business, as their investment vehicle. They want to keep the two things separate. They don't want to have more than, the two things linked in with each other. But they do want to move the money from the trading company into the SPV. And so traditionally, there are several different ways which you can do that. I'm not going to go into them all today, but what we're seeing is a definite shift towards people looking to set up a subsidiary company for the SPV, where they would move money from trading company to SPV. And because the SPV is owned by the trading company, you can move the money around without a tax charge essentially being incurred. Whereas if you took the money out of the trading company into your personal name to then pay it into the new SPV, that would be a taxable event essentially. So that's why we're seeing how these really sort of come to play in reality. Now, in terms of if a layered company is something that you are considering or you already have, how does that land in terms of getting a mortgage? So look, lenders are definitely becoming more open to these as we're seeing more and more borrowers with this kind of structure. What the lenders tend to want to see is that the directors are the same directors for each company. So in the case we just gave, in our IT consultant is director of the IT consultancy business and the SPV, and they're the only shareholder. If I had two directors of my IT consultancy, they would need to be the same two directors of my SPV, and they would need to be the shareholders. It needs to be the same people all the way through, if that makes sense. Currently, there are 10 lenders who accept layered company structures, so there is plenty of choice out there for you if this is the way that you want to go. In terms of whether this is the right way to go for you, again, you're going to need to speak to your tax advisor about these. Now, in terms of the frequently asked questions that we receive with regards to limited company lending, there's definitely a trend in terms of the things which crop up most often. So I thought it was worth just going through these with you. And we will have covered some of these in some way, shape or form throughout the presentation. So the first thing we get asked is, often is borrowing through a limited company expensive? And as we've discussed already today, there's no denying the fact that the interest costs are certainly higher when going through a limited company. There can also be additional costs in terms of independent legal advice and using your own solicitor, potentially, if that's how things kind of shake out for you. But you have to weigh these costs up against the tax implication of not going through the limited company. As we previously outlined, the reason people tend to use limited companies is driven by a desire to be tax efficient. And so what you would need to do is get an appropriately qualified person to sit down and essentially line up the costs of borrowing personally versus through a limited company, taking into account the mortgage cost but also the potential savings on tax, and really then you'd make an informed decision about which one in the round works out best for you. So yes, the cost can be a bit more expensive, but actually there needs to be a kind of, I feel, a pragmatic business decision which sits around the overall cost of doing it through a limited company or not. Now, we've also talked about whether you can indeed take a mortgage out through a newly set up company. And yeah, absolutely, just to recap on that, yes, you can certainly set up a limited company and borrow through it the next day. Or you can take a limited company that's been set up for many years and also borrow through that. It really doesn't make any difference, because fundamentally the people who are responsible for making sure the lender gets their money back at the end of the day are the people that take ultimate responsibility, and therefore actually the company itself is essentially a wrapper which sits around the deal. Now, in terms of income requirements for limited company lending, so there are maybe 5 lenders at the moment, roughly speaking, who do have a minimum income requirement that tends to sit at £25,000 per year. These lenders do accept rental profit as an acceptable source of income when looking at that particular figure. But the lion's share of lenders who are operating in the limited company space work on the basis that they do not mind how much you earn as long as you are earning something and that the case makes sense. So by that, what I mean is this: if you are earning £27,000 a year, you have a home mortgage of £500,000, you have £20,000 on credit card and a car on HP of £300 a month, versus someone who earns £10,000 a year but has no home mortgage, no other unsecured debt. Actually, the person who has more disposable income would be the person earning £10,000 per year, not the higher earner. So from a lender's perspective, I don't mind how much you earn, but they have to be comfortable that actually, the reality is you're in a good financial position and the mortgage is, affordable nonetheless. Now, another question we get asked often is there a limit to the number of properties that you can have in a limited company? Should you have one company per property, or can you have an unlimited number of properties in a company? Now, there are varying schools of thoughts in terms of the right way of structuring this, not from a mortgage perspective, but from a wider investment sort of strategy. But from a mortgage perspective, there is no restrictions on this. So you can have 1 or 1 million properties through a limited company if that's your want. Lenders do not mind, there's no restrictions here. In terms of the number of properties you can have more generally, again, as I mentioned, I think earlier on, lenders don't tend to, in the limited company space, mind how large your portfolio is in the background. They will all cap how much, you know, they were willing to lend to you as an institution. So it might be that, I don't know, Precise Mortgages say, well, okay, we'll lend you either £5 million worth of borrowing, or again 10 mortgages, whichever comes first, but they won't mind how much you've got in the background. There will be some kind of checks in terms of the background portfolio if you're a portfolio landlord, to make sure that you're not overly geared and that your rental income is sufficient to really support your portfolio, so make sure that you're in a strong financial position. And portfolio lending is a whole nother presentation in itself, so if you do have any questions on that, please do just get in touch. But fundamentally, that just on a kind of very much a standalone basis, there are no restrictions in terms of how many properties you have in the background and how many properties you can put in your limited company. Now, the other question we get asked often is, how do I actually get money into the limited company in terms of deposit? You know, am I expected to suddenly have a company which has got lots of money in it, you know, having never traded before? And again, this is really going to be something you're going to want to get some tax advice on. The most common way that people will put money into their limited company will be via a director's loan. So I am setting up my limited company. I have £50,000 in cash in my personal name that I want to put into the limited company. I will lend that to my company via a director's loan, and that forms my deposit. The other thing, as I mentioned earlier on, is a situation where you've got a trading limited company with some money in it, where you move the money across from trading company directly into the SPV. And as I mentioned previously, there are several ways of doing this, and again, you'd want to get advice from your accountant. But fundamentally, there are sort of different ways to skin the cat in terms of how you would move money into the company to act as deposit. And that's really everything for today in terms of our presentation. So just to recap, there's a huge appetite from lenders to lend to limited companies, and it's growing all the time. You know, there really is, you know, enough lenders out there with a good credit appetite that we can cater for pretty much every eventuality, whether it's people with really large portfolios, if it's complicated company structures, if the property itself is a little bit weird and wonderful. We can generally help pretty much everyone that we speak to, which is really positive. And we've also seen the pricing ease over time. As I mentioned, you know, things have really come down in the last few years, and we do think that rates are going to sort of ease a little bit further over the coming few months. And in terms of the criteria on loan to values, again, you know, 75%, there's lots and lots of options. You can push it to 80, and if you're really brave, 85% loan to value as well. So look, if you do want to have a chat about anything we've talked about today, we would absolutely love to hear from you. Please do give us a call, 0345 148 9172. There's also an absolute abundance of information on our website in terms of mortgage rates, calculators, case studies, blogs, you name it, it's on there. So do go and have a look at our website, mortgagesforbusiness.co.uk. And really just lastly, thank you so much for taking the time to join us today. I really appreciate you having a listen or watch to what we have to say. So yeah, enjoy the rest of the National Landlord Investment Show, and hopefully we'll get to speak to you very, very soon. Thanks so much.